All right, all right, all right. Thank you for being at the National Lunch and Learn League event for what I think is a pretty important topic for real estate professionals. I mean, tax strategies are all about a higher net income, right? And while we're broadcasting this initial live event on Wednesday, April 3rd, that gives you about 12 days till tax day. But if you're a residential real estate agent and you're incorporated, if you're in a state that legally allows incorporation, you actually do this every quarter. You file your quarterly taxes. And, we thought Annie Mac Home Mortgage and the National Lunch and Learn League and Annie Mac Works thought that, since we're creeping up on tax time and you could be paying Uncle Sam more than you have to, we'd like to really dive into how you, if you are self-employed, some of you as residential real estate agents, even the broker owners, team leaders, sales managers are self-employed individuals. Therefore, you have kind of a completely different spectrum of income tax considerations than say a W-2 employee has to consider. I'm going to introduce you to a couple people today that I think you should know. I have been doing this business since 1986, and I'll just jump to this slide with my beautiful wife, Carrie, who some of you know well from other classes. My name's Russ Fitzpatrick. I'm one of the lucky founders of the Annie Mac Works Realtor Productivity Platform. My background is all residential real estate, but I'm going to tell you a secret today as you're all getting to your seats, getting out your pen and paper. Make sure you're going to be able to take some good notes today, because I guarantee you will learn something today. And I also guarantee that if you apply what you learn, you could save some money on your taxes. I was audited 3 times by the IRS, and I will tell you that is not a fun process. But if you've ever seen an NFL player spike the ball when they get into the end zone, I will tell you that getting a no change on an IRS audit is better than scoring a touchdown. I think it's might be like winning a Super Bowl, man. It's you just went through a deep investigation of your tax return, and at the end the IRS said, "No, you don't owe us any extra money." In fact, on one of the cases, they had to refund even more money back to me as a result of their audit. So I had 3 no changes with the IRS. Now, since then, I changed my accounting services company, and I haven't been audited in 20 years, I think. I was lucky because I was only making a couple $100,000 a year when I was audited. And when you're audited and you make $200,000 a year and you take 6 figures of deductions, man, they're curious. How did you make 200 and you took 150,000 in deductions? Or if you made 240 and you took 160 in deductions, that might red flag the IRS for an audit. But I can tell you, I've managed realtors now my whole life. I teach, train, and coach realtors all over the country, and I work with some of the highest earners in the residential real estate profession. And we talk turkey behind the scenes. We talk about, over a cocktail, over a glass of wine, over a dinner out. We talk about tax strategy. And I want to point out that, one of my favorite instructors in the world is a guy named Dave Ramsey, and Ramsey Solutions Financial Wellness Coaches have become a part of Annie Mac Works because we believe so much in the financial wellness, financial security, financial preparedness side of this industry. And that quote from Napoleon Hill at the top of this screen, I think sums it up. Men who manage men who manage things, but men who manage money manage all. And that's what Napoleon Hill wrote at the turn of the century. And I think Dave Ramsey, Susie Orman, countless other financial wellness advisors have really started to understand. And I hope that this is the sentiment that you get. It's not how much you make, it's how much you keep. You know, if you make $300,000 a year and you spend $90,000 a year on taxes, and at the end you don't have 30 to 50,000 a year building in your life's savings account, you are making some huge mistakes. Now you break that down to someone who makes $30,000 a year and they pay, five, six, seven, eight, $9,000 a year in taxes, or whatever the case might be, and then they don't put as much money into personal wealth building, investment properties, investment retirement accounts, and then all of a sudden, the real estate agent gets broker and broker and broker. Some real estate agents are aspiring to be a broker, but they just keep getting broker and broker and broker. I'm sorry, but it's really hard to watch people who don't focus on managing money as much as they focus on taking listings and driving income. So we're going to use this little graph to kind of illustrate something to you. We're going to use a round six-figure, $100,000 gross income, and then kind of a split conversation. It's a variable, obviously, and then marketing expenses of, let's just say, about $15,000 a year. And then all of a sudden, you've got a $20,000 in tax burden there, and you end up netting your take-home pay is about $45,000, or less than $4,000 a month in net income after you've grossed $100,000 in commission. So you had to sell $3.2 million, 3.333 million, or whatever it is, in residential real estate to get your measly $4,000 a month. And there's got to be a better way, right? And so I look at this opportunity in twofold. On one hand, when you reduce your tax burden, you could spend more money on marketing expenses. So maybe your $80,000 that you have in income, you're able to spend, say, 15,000 or even 20,000, 25,000 or whatever in marketing expenses because your tax burden went from 20 down to 10. You see what I'm talking about? So the spread that you saved in tax burden, you're able to reinvest that back into your marketing budget and your expenses. And so few realtors can expand their market share because they don't have the marketing and expense budget. Conversely, the other side of the coin is that you simply reduce your taxation so that you can increase your net. Not a bad decision either. As you see the same gross commission income after brokerage split and or marketing expenses, you end up with a $5,000 tax burden rather than a 10 or 15 or $20,000 tax burden, and therefore your net take home on the same gross income is 60,000, which is better than $5,000 a month, rather than the $4,000 a month. So I hope that this kind of rudimentary analysis hits home with some of you. I'm going to go back to this slide because if I had one kind of crystalline vision for our relationship, is that you would have a geographic farm area. You would have an area of specialization that you marketed to regularly. And that area of specialization, that farm area, would become a substantive foundation for your income. Well, you can't farm unless you have a little budget, right? And then, you would become very, very proactive in your sphere of influence marketing. You would start to mine your database with direct mail, email, telemarketing, you know, handwritten notes, um, probably some email marketing, and maybe even some video broadcasting, not just through social media, but through emails out to your sphere of influence, your friends and family, your past customers. Well, all that stuff takes a little bit of money. And if I had one wish for you as a direct result of this course that we're going to dive into here in a minute, it would be that your taxes reduce in a way that doesn't necessarily increase your net day one, but allows you to invest some of those dollars that you were giving the IRS, some of those dollars you were sending to the federal government or the state government, you were able to reinvest back into your farm area or your database mining. Because if you want the secret pill for residential real estate's highest producers, it's create an area of specialization that you farm and do a proper job mining your database of your friends and family and your sphere of influence and your past customers. So I would love to win a relationship with you that saves you 10, 12, $15,000 a year in taxes this year as a direct result of what you learned today. And then because of that, you're able to spend a little bit of money marketing yourself into your farm area and your sphere of influence. So this is called Tax Strategies and Incorporation Opportunities for Real Estate Professionals. I don't think we're ever going to make it on Netflix with that title. It's just a long title, but Tax Strategies and Incorporation Opportunities for Real Estate Professionals is today. And I'm going to start off with quoting Robert Kiyosaki. The power of a corporation, and I know not every state allows realtors to incorporate, but I like this paragraph from Mr. Kiyosaki, how to legally protect your income and keep more money. A lot of people think that there are two sets of rules. I remember when Mitt Romney was running for president and the reporter was interviewing him on his private jet. And he says, "Why didn't you pay very much taxes, Mitt Romney?" And everybody's on a particular politician or a particular wealthy person because they pay less taxes than as a percentage of their income than everybody else. And they say that there's rules for those who are successful and there's rules for everyone else. But in reality, Mitt Romney and Donald Trump and Ross Perot and Andrew Carnegie and John D. Rockefeller and Bill Gates and Steve Jobs, they all operate under the same rules as you do. They just pay a lower percentage of their income towards taxes because they're better at using the rules to their advantage, which everyone else doesn't do. And what Mr. Kiyosaki says is that this is the fundamental difference. One way in which successful people use the rules of money to their advantage, and they do that primarily through corporations or understanding tax strategy. I think after 32 years in residential real estate, and I put this book in my son's hand when he turned 20, absolute required reading for real estate agents is Rich Dad, Poor Dad by Robert Kiyosaki. It is almost a cliche because it's so widely revered and well respected in our industry. But too many, and I will go ahead and say it, too many real estate agents are ending up broker and broker and broker, and they're not manifesting wealth through this glorious profession called residential real estate. So one of Robert Kiyosaki's harsh realities is that if you receive a 1099 as a person or you receive a W-2 as an individual, you earn the money, then you're taxed on the money, and then you spend the money. As an employee, you take in your earnings, and then you in fact pay taxes on that earnings. And then after you pay taxes on your earnings, you get to spend from what's left. If you're lucky enough, and you are lucky, if you're in a state that allows a real estate agent to incorporate, then it's a different equation altogether. You earn your money, you spend your money, the corporation spends its income, and then it pays taxes only on what's left. And you make the rules here, guys. As long as it conforms to the tax code, the corporation decides what it spends its money on. Um, Wild examples, a corporate yacht. I mean, who could create a tax deduction for a corporate yacht? I mean, going to a football game for a W-2 employee is a entertainment expense. Going to a football game at a $70,000 a year skybox is a tax deduction for a corporation. Ordering a spread that is at your tailgate party is an expense for a W-2 employee. When you're a corporation, you're hosting an event and individuals are invited to the corporate, environment. And I use this example all the time. One of my friends who runs a corporation had a Skip Barber racing school team building event. He brought all the executives from his corporation to a Skip Barber racing school as a team building exercise, and it was maybe a $15,000 or $20,000 expense. And at the end of that weekend, I mean, those boys had a lot of fun, man. They were driving Porsches across a racetrack and spinning out and having a ball. And the whole thing was tax deductible. On the other hand, my father, who was a police officer, he paid $1,200 to go to Skip Barber Racing School, and that was taken out after taxes. So think about that in the scheme of residential real estate. If you're in a state lucky enough to allow incorporations, I'm gonna go ahead and strongly endorse and almost advocate for you to make this call today. If you're in a state that is lucky enough to incorporate and you make anywhere between $15,000 a year and $150,000 a year or more, I recommend that you call my boy Steve Dahlia. He's down here in 954 with me in Fort Lauderdale. He runs a company called Dahlia Sales and Marketing. His phone number is right there on the screen, and I just noticed my little typo there. I recommend that you call him, text him, or email him. And if you are allowed by law to incorporate, it is probably the single most important thing you could do for a couple $100. And I say a couple hundred, like 160 to 250 range cost to incorporate. And there's only a couple states that he listed in my conversations with him that you were not allowed to incorporate. So I apologize to my friends in New Jersey. I apologize to my friends in Tennessee, down in New Orleans, in Louisiana, and in Michigan. You cannot, as per his best knowledge, they do not allow realtors to incorporate in those states. But almost every other state in the US gives the benefit of incorporation to the residential real estate professional. So this guy, Steve, and I have known each other for 20 years, 17, 18 years anyway. And he worked for me for about 10 years. And now he runs incorporation, um, you know, processing for a nationwide audience of realtors every day. I love this guy. He's trustworthy. He's cheap as hell. I think it's under $200 for most states. It might be 250 in some states, but you're talking about a very small investment in the opportunity to incorporate. So if you understand what I was saying before, gross versus net, spending before taxation and all those things, you might want to dial 954-415-4515 or email sdalia@daliasales.net. There's a lot of services out there that do incorporate for you. You can actually do it yourself. It's not terribly difficult, but if you want a professional to incorporate you and remind you when your filings are due and remind you at the beginning of every calendar year when you're supposed to do your updating, that guy is as good a friend of mine as you'll know in the world, and he did my incorporation, and he's done incorporation for many of my friends. So on to the next topic, and this is the difference between, I think, poor people and rich people. And I'm sorry to say it so crass, but low income versus high income people. Low income people go to H&R Block, Jackson Hewitt, go into Walmart and file their taxes, or they buy some $90 software, and they really believe, a lot of people I talk to, probably 70% of the people I talk to, think that tax preparation is the same as tax strategy. And the truth is tax preparation is really just filling in blanks in a box. Think about an IRS 1040 form or a form, and you're filling in information into a box. So when you see an ad that says get your taxes done for free, or we'll prepare your federal taxes for no money, or we'll do it for $200, or Jackson Hewitt at Walmart will do it for $90 or whatever, that's tax preparing. That's filling in the boxes with the information. Tax strategy, tax planning, tax consult, giving you direction about how to prepare your tax return, giving you counsel, giving you advice. There are, multi-million dollar CPA firms that advise companies on tax strategy, right? So it's not just about tax preparation, it's actually more the thinking and the planning and the managing of the money in the way that puts the IRS in um, a position where you're following the tax code and it's irrefutable, but you're taking advantage of every opportunity you can, excuse me, in that taxation conversation. So I'm going to tell you real quick, and then I'm going to introduce this guy. I'm going to tell you why I love Tony. Okay. Now, Tony is not Tony Robbins. He is not a motivational speaker. He may not make you laugh. He may not keep you entertained, but here's why I love Tony. Tony is a former IRS agent. Tony is a former IRS auditor. And Tony is a former IRS fraud investigator. And Tony is the person who prepares my taxes each year. And Tony is the guy that I sit down with about 4 times a year, and I spend as little as an hour, sometimes less, just making sure that the quarterly opportunities and the planning and the strategy meets the income versus the expenses, and that we're taking advantage of everything that we can take advantage of in the tax code. He runs a company that I am very intimate with, and I spend a lot of time with him on a business service and support network organization, Business Services and Support Network, bssnusa.com. I provided a 1-800 number there for you because I would love to have an army of anti-Mac workaholics across the country that pay the least amount of income tax possible because they're getting the proper tax advice and counsel from an experienced IRS agent, IRS auditor, and IRS fraud investigator. He represents real estate professionals nationwide. I called him and asked him if he would come in and film this conversation with you. And I'm so very, very proud of the width and depth of this conversation. And I'm so very, very proud that he was willing to put the time in. You'll notice he's probably not a natural television guy, but I love him. I appreciate him. He's filed my taxes for the last many, many, many years, and he never got me involved in any audits. He actually keeps my life very, very peaceful with the IRS, and I couldn't appreciate Tony more. So having him come on and talk to you for 15 or 20 minutes at this Lunch and Learn is a great gift to me personally and a service to you. If you happen to dial his 1-800 number, if you happen to go on his website and get to know him, he can help you file your taxes nationally, and we certainly appreciate Tony coming on.
Hi and welcome. My name is Tony Pastano. I'm an accountant in South Florida and a certified fraud examiner, ex-IRS agent. Today we're going to talk about the effects of taxation on real estate professionals and what we can do and we cannot do in relations to the profession. Briefly, I'm going to talk to you about 2 sections of the code, Section 61 and Section 162. Those are really the only 2 sections you need to be familiarized with. But before we talk and get into details on that, I want to take an opportunity to talk briefly about how to file your taxes, whether you should do it as an individual, as an LLC, or a PA. And again, that is a topic for another section with somebody else. However, I want to briefly touch on that. The IRS looks at individuals within the same profession and compares them to each other. So let's say you have John and you have Joe, and they're both realtors within the same area or zip code, and John makes an average of $300,000 a year, while Joe makes an average of $50,000 a year. While that may be true, Joe will probably fall outside of the realm of what IRS considers an average income, and he has a greater chance of being looked at or being audited. Okay. Now, audits come and go, as they say, and it's not necessarily what we think of an audit is necessarily a nightmare. Sometimes an audit would just constitute just getting a whole bunch of receipts in and just presenting the receipts. Okay, so what if you don't have the receipts? Well, if you don't have the receipts, they're not going to take you and torture you and flock you, although they may want to, but they can't do it. So trust me on this, they cannot do it. What they will do is they will say, okay, we're going to give you, most likely what they will say is, okay, we will give you a reasonable amount of your expense that you're claiming. So it is highly unlikely that a real estate professional, and IRS knows and the world knows that you guys do a lot of driving and traveling, is going to be denied 100% of his vehicle expense. For example, IRS will come in and say, give me all the receipts on it, of your mileage. You don't have the receipts, you don't have the mileage. Okay, so what we'll do is we will turn around and give you a reasonable amount of mileage, so you still get a little bit. Not as much as you would like, but something. Having said that, and going back to the concept of whether you should file as an individual or as an entity, it being an LLC or a PA or a corp or an Inc., IRS compares corporations to corporations, individuals to individuals. So if you're a little guy and you form your own PA, for example, you're going to be compared to some of the bigger real estate companies. The result is they're going to be looking at the big and middle guys and not so much you, because they know that you're a one-man show, one-person show, I should say. So my recommendation is form a PA, form an LLC, one of the two. Now, if you form an LLC, you want to make an election, it's called, under using form 2553 to become an S corporation. Why do you want to do that? The reason you want to do that is because your profit or loss is going to flow from the corporation over to your personal tax return. Well, yeah, we all know that if you have an LLC, you're going to file as a partnership. Typically, if you don't do anything, if you don't make an election to be treated as an S corporation, and you're going to file as a 1065 partnership, and it will still flow over to you. However, if you do not do anything, and you just file as a 1065, what's going to happen is it's going to flow over, and if you have a profit as an LLC, you will be paying about 15% more than the guy right next to you who has an S corp. So be sure to elect to be treated as an S corporation. That's number one. Number two, as an individual, it's hard to keep records. At least for me it is. My wife keeps all the records. I keep no records. I'm horrible at it. Okay? So what we want to do is we want to make sure that we have the tools and the records necessary to provide IRS in the event that they call or they ask for them. the information they're requesting. Like I said initially, it's not the end of the world if they do and you don't have it, but you want to have it or have as much as possible. So what do we do? How do we keep these records? My recommendation to everybody is simply keep everything. When in doubt, keep everything. Okay? Maintain a log of your mileage. Where am I going? How many miles? So on and so forth. That will help your tax professional prepare and take a deduction for your automobile. You want to keep every single receipt you have? Yes, you do. Some people say no, I say yes. I even have clients that keep a garbage bag next to them in their car, and as they go along, they just throw throughout the year their little receipts in there. Okay, at the end of the year, one of the girls in my office will take each little receipt, categorizes it, puts it in a spreadsheet or in some other software, and we come up with what the total meals and entertainment was, what the total gas was, travel expenses, and so on and so forth. So that's one way of doing it. A more civilized way of doing it is by taking and opening up a bank account for your PA. And you run all of your expenses through their PA. And then you have a bookkeeper who is a professional who knows what each category is. That bookkeeper will turn around and they will categorize each one of those expenses, and they will summarize for the accountant, for the CPA, the expenses, so that your tax return is properly formed. Because the expenses and those numbers come from usually a bank statement, then we have the backing right there. You know, IRS will most likely accept just the bank statement charges as they appear. Now, why use a bookkeeper? You know, why do I want to pay, you know, what, $100, $200, $300 and up on a bookkeeper per month? Well, IRS has this little thing called intent. And here's where the nightmares that you hear about with IRS come in. If you lose your receipts and you put on, you know, you had a travel expenses of $4,000 and you can't prove any of these receipts, IRS can turn around and say, okay, we'll let you go this year. Now we're going to look at the year before. So they go the year before and they find the same thing. Okay, we're going to look at the year before that one. And they look at it and they see the same thing. So now things are getting worse, right? You know, and believe me, IRS people cannot take a joke. So they just keep on doing this, and finally they say, well, how is it that every year you have the same issues and you always lose your receipts and you always have this problem? I think this whole thing is intentional. Intent is one of the batches of fraud. Without intent, they cannot prove fraud. So the result is, when you hear the word fraud, you can associate that with jail time, criminal charges, felonies, and so on. So you want to avoid that intent issue, even if you're doing it in good faith. By having somebody else do it for you, you haven't touched it. So how can you have intent? Right? And if you want to get even more sophisticated, you can outsource. That's what some of the big companies do. They outsource their bookkeeping overseas. So IRS comes along and they say, well, let me see the books. Well, who did the tax return? I did. And who did the books? Well, the client gave them to me. Okay. And where did the clients get it done? Well, he got it done in, I don't know, Japan. And if you want to go and interview, you know, we based everything on what the Japan bookkeeping company did. After all, Accounting is accounting every place in the world, right? So that's why you want a bookkeeper, in order to minimize your liability as far as intent is concerned. Now, if you don't want to spend the money on a bookkeeper, then you can turn around and you can use Excel or QuickBooks or take a class on doing it, okay, if you have the time. So having said that, let me jump into some of the more typical deductions and what is required. Well, obviously, every real estate professional has expenses related to automobile expense. There's two ways that you can take your auto expense. One of them is the direct method, meaning you keep your receipts and you add them up, your gas, your maintenance of your car, your tires, your car payments, to calculate your depreciation on the car. And then you got to figure out what percentage of your usage of the car was for business. So here I'm going to take a break for 1 minute and I'm going to talk to you about Section 162. Section 162 of the Internal Revenue Code says basically that in order for an expense to be deductible, it has to be ordinary, necessary as to the business. So, can you have a car being 100% deducted when that's your only car? Obviously not, because you're using that car to go from your house to the business, to the office. That's not deductible. From your house to the business is not a deduction. The deduction starts after you get to the office and you go visit and show a house or do whatever you're doing, canvassing or whatever, okay, in the neighborhood. So the individual that has one car can never have 100% deduction. But let's say that you have two cars. Well, if you have two cars, one of them you can use 100% of the time for business. It will be on you to be able to prove it. How do you do that? Well, you got to keep the receipts, as I said, but in addition to that, you have to keep a log of the mileage where you go. Well, I went over here, I went over there. I left the car in the office, and I take off with their car every day to go see my clients and show houses. So now you have a car that's 100%. Typically, what we find is that the individual who has one car, or even two cars or three cars, will use their car a partial time for business. And what they do is you compute the total mileage from the beginning of the year to the end of the year, and then you divide that, or I should say you compute the total mileage used for business, divide total mileage used for business, divided by total miles for the year, and you come up with a percentage. And that percentage is the one that we use to multiply times the gas, times the repairs, times everything. And that's how we come up with the auto expense. Regardless of whether you use that method or you use the method of the 52 cents per mile that we have, and that amount changes every year, we can turn around and show that whatever the percentage it is that is being used. You either take the mileage method or the direct method, actual method of adding up your receipts. One of the two. You get only one bite, not two. Okay? Now, continuing with actual necessary expenses. Obviously, the use of the car is an ordinary and necessary business expense, like Section 162 says. All right? Telephone. Well, telephone of your house, is that necessary and ordinary for the business when you don't have an office at home? No, it's not. They will disallow it. unless you can show that you have an office at home. If you have an office at home, then you can deduct a portion of the telephone, a portion of your rent or mortgage, a portion of your house taxes, a portion of your gas in the house, a portion of the maintenance of the house. Okay, and how do we calculate that? What we do is we take the total square feet of the area which you are exclusively using as an office at home. So if you have a room 10 by 10, you got 100 square feet. Divide that number divided by the total square feet of the house and multiply that times your telephone cost for the year, your taxes of your house for the year, all of those expenses related to the house, and that is your office at home expense. That's how that's done. So obviously supplies, office expenses, the cost of your signs, all of that are normal, direct, obvious expenses. What about uniforms? Now, realize something, you guys in the real estate business have to look good. You have to be presentable. You can't come in and drive up to pick up a client in a 1998 Chevy, whatever, throwing smoke out of the back. I don't think that's going to fly. Plus, your broker will probably get rid of you immediately. So you need a car that is presentable without being luxurious. So IRS would allow for a car, a new lease, the same rules apply. It doesn't matter, just because it's a lease doesn't mean that you can take the full 100% deduction. You still have to go and calculate your miles in order to determine business use. On the other hand, if you turn around and you calculate total expenses, including a lease, for say a Rolls Royce, okay, and you're driving around showing houses of $120,000, IRS, in the event that they were to come in and do an audit, that's not gonna fly. They're not gonna allow that. And if they do, there'll be a fight. There'll be a struggle. So you have to be reasonable as to your expense. You can take a bite, just don't take a chunk. Just let the government keep their share. Okay. What's questionable is how much of a share they should keep. Some of the expenses that are more questionable that we can get around are, and going back to your presentation, what you look like, your image, okay, as a professional, are clothing. So a lot of the women are going to turn around and buy this very expensive dress, and they're going to want to deduct it because they are real estate professionals. Or you can turn around and buy a suit with worth $2,000-3,000. The one thing that the courts have ruled on is that in order to take the deduction on clothing, it has to be, again, ordinary necessaries to the business. What that means is that it cannot, what they have interpreted from that is that they cannot be used anyplace else. It is exclusive as to the business. Okay, so if I have an expensive suit or tie, is it deductible? Can I say, well, this is my uniform for work? No, it's not deductible if I can wear it someplace else and not be noticeable as to anything, call attention to it. It's a very fine and very discussed area of the law in law cases. What we do know for certain is that if you turn around and you take your suit or your dress and you have the name of your PA, your LLC, or the logo of your PA and your LLC embroidered onto your clothing so it becomes visible, then it constitutes a uniform. Now, that $3,000 suit becomes deductible. That $3,000 suit that was otherwise just plain clothing for yourself, now it becomes a deduction. So again, the whole issue of being reasonable, and it has to be material as to the expense. It has to be reasonable and necessary for the business. How about a bolt? Your realtors, you take out your clients back and forth, and you spend, sometimes you spend more money on the client than what you're actually going to make if you count gas and everything else. Well, some clients that we have boats, yachts. This is South Florida, and they want to deduct the use of the fuel and all of that. Again, we go back to section 162. It said necessary and ordinary as to the business. So if you take clients, and I have a party on top of my boat, okay, I go out in the middle of nowhere. The question becomes, is it necessary or ordinary as to the business? If I show that because of that party that I had on top of the yacht, I actually received more clients, or I actually got more clients, and I actually made some sales, then I can prove that it's ordinary and necessary. And again, one of those areas that can be discussed, and it can be, it can be really a headache. IRS prefers not to make a decision like that, and usually leaves it up to the courts, up to the tax court to make the decision. Other expenses like insurance, continuing education. Here's one: gifts. Gifts to clients. Make sure that if you provide Christmas time, holidays, whatever, you send gifts to the clients. Make sure you keep the list of who you gave the gifts to. You have that one diamond ring for your spouse. It's not going to fly. They're not going to buy that one. That's a gift for a client. Okay. Legal and professional expenses, yes. Business loan interests, yes. We already talked about uniforms, and again, you have to be reasonable as to what it is. Today, most real estate professionals who get paid through a broker get at the end of the year something called a 1099. A 1099 does not go attached to the tax returns or with the tax returns or anything, because the broker or the professional who's doing the books and taxes for the broker is sending that 1099 directly to IRS. So IRS has it. If you have a PA or an entity of some sort, that you should not guide yourself by just the 1099. Rather, you should be adding all of the deposits in the bank account for the entity until you determine what your total income is. That brings me to the second section, section 61, that defines and says what is income. Okay? And the section is very clear as to what is income. Everything is income. Simple as that. Everything is income. So, listen, I'm from Mexico. I'm a U.S. citizen. Got my real estate license here, and but I still do business in Mexico, and my money that I make in Mexico stays in Mexico. Okay. Well, guess what? You have to declare whatever you made any place in the world here in the United States as income. So whatever you made in sales any place or as income, or you received as income any place in the world, you have to receive it. You have to declare it. What about issues like, well, I have a Peruvian client, and the client has a building in Lima, Peru, and I exchange my two-bedroom house here in South Florida for their building over there. That's a taxable event. They're gonna, although there was no money involved in it, they're gonna look at the value of that property over there, the value of the property over here, and they're gonna determine profit and loss that way. So Section 61, everything is income. Does that mean that the love your wife provides you is income? No, it's not taxable. You cannot deduct anything on that one. But everything else is. So, having said all of this, make sure your deductions are ordinary, necessary as to the business. Don't cheat. Don't go ahead and do tax evasion. You can do tax avoidance by planning ahead of time. And planning is the key. If you wait until December to say, go to your accountant, to your CPA, and say, hey, do I owe money? Am I going to owe money? Well, there's not much he's going to be able to legally do. But if you come in February, March, and you start planning and you start looking at the current year, then there's a lot to do. There's a lot of ways of cutting back and reducing your exposure as to tax liability. I thank you. And again, my company is Business Service and Support Network. You can visit us at www.bssnusa.com or call us toll free 1-800-230-3848. Thank you. See you next time.
Hey guys, I hope that was a good session with my buddy Tony for tax strategies and the incorporation opportunities. If you happen to be in a state where you can incorporate, remember the rules of Rich Dad, Poor Dad, understanding how you can earn, spend, and then be taxed if you run a corporation. Introduce you to my buddy Steve Dahlia at 415-4515. If you do reach out to sdahlia@dahliasales.net, let him know that Russ sent you. And if you really want to get a higher net income, if you really want to have more money in your checking account at the end of every month, you really got to start to think about tax strategy, not just tax preparation. And one last endorsement and big thank you to my buddy Tony Pastano, my personal CPA accountant at Business Services Network USA, representing real estate professionals nationwide. If you didn't get his number already, pound it down your throat, because I do believe having a realtor specific specialist in the tax strategy is important, because your particular industry has some features, advantages, and benefits in tax code that not a lot of people could take advantage of. Reach out to Tony, 1-800-230-3848. But either way, Annie Mac Home Mortgages loves and appreciates this opportunity to add value. The National Lunch and Learn League happens on the first Wednesday of every month, and we hope to see you again next month. Thanks so much for being here.